All right, today we are diving into a really provocative financial analysis from Phil Davis over at philstockworld.com. He's drawing a direct line between the Federal Reserve, the actual money in your pocket, and one very controversial cryptocurrency. So let's break down how he connects all these dots. So the author kicks things off with this one really stark number, negative 12.36%. Now, what is that? Well, according to his analysis, that's how much the US dollar has fallen against other world currencies just since January. That's a pretty significant drop, and it raises a huge question for anyone, holding dollars. And this leads us right to the central question he's posing. If your money's in dollars, this kind of decline hits your purchasing power directly. So the big question is, what does he think is causing this? Okay, so at the very core of his argument is the Federal Reserve and its interest rate policy. He's claiming there's a direct link between the Fed's actions, which by the way he says are being influenced by the president, and this weakening dollar.
So how does this work exactly? Well, the author says it boils down to basic economics. When the Fed cuts interest rates, holding US dollars just becomes a lot less attractive for foreign investors who are looking for higher returns. So what do? They sell their dollars. This floods the market, and, simple supply and demand, the currency's value gets pushed down.
And this, he argues, creates what he calls a vicious cycle. It all starts with the rate cuts. Then, as the dollar weakens, everything we import, I'm talking from gas to groceries, it all gets more expensive. This inflation then puts even more pressure on the Fed to cut rates again to try and ease the burden on consumers. And in his view, the cycle just repeats itself. But this is where the analysis takes a really sharp, really controversial turn. He argues this economic policy isn't just some abstract theory. No, he says it's directly connected to the world of cryptocurrency and what he alleges is a massive conflict of interest. And he does not mince words here. He describes the entire crypto market as a Ponzi scheme. He argues that cryptocurrencies don't actually produce anything of intrinsic value. Their price, he claims, depends entirely on new buyers coming in, and their money is then used to pay off the early holders. To make his case, he really zooms in on one specific example, the Trump meme coin. According to his research, out of the 1 billion coins that were created, 800 million, that's a full 80%, were kept by the promoters. He says only 20% were actually sold to the public, and that over 764,000 of those investors are now underwater. The author calls this structure a classic insider pump and dump. He even gives an analogy. Imagine if McDonald's sold you a Big Mac, but kept 80% of the burger for itself. That's his whole point, right? The vast majority of the asset allegedly just stayed with its creators. So how does this all tie back to the Federal Reserve and the US dollar? Well, this is where the author connects all the dots, putting some pretty staggering numbers on what he calls a completely unprecedented conflict of interest.
And here it is, the contrast at the absolute heart of his argument. On one side, he calculates that the dollar's decline has wiped out roughly $12 trillion in purchasing power for the American public. On the other side, he alleges President Trump's personal crypto portfolio has gained $5 to $7 billion, supposedly from the very policies that weakened that same dollar. So this is it. This is his ultimate accusation, that the president is personally profiting from policies that devalue the very currency that every single American depends on for their daily lives. Now, his analysis doesn't just look at the past. This article was written on Fed Day, right before a major interest rate decision was announced. So he also lays out a kind of playbook for what he expects is going to happen next. First, let's set the stage. The author notes that the financial markets have already pretty much priced in a 96% chance that the Fed is going to announce a quarter-point rate cut. That's 25 basis points. This means the cut itself isn't the real surprise. The real action, he says, is going to be in the little details of the announcement. Based on that whole setup, he outlines 3 possible scenarios. The most likely, what he calls the base case, is that the Fed cuts rates and signals that more cuts are coming. He predicts this is going to weaken the dollar and send gold and crypto ripping higher. Then there's the hawkish surprise. That would be a cut, but paired with some really cautious language, which could actually stabilize the dollar. And finally, the long shot, the shock and awe scenario, a big 50-point cut. In his view, that would cause a big flush down in the dollar and an explosive move higher for crypto. And the author leaves us with this final, very provocative question. Beyond just the immediate market reaction, he asks, will this decision be remembered as the spark that ignited the dollar's next major leg down? It's a powerful thought, and it really highlights the long-term stakes of a single day's policy, all as seen through the lens of one very critical analysis.